very, very warm welcome to everybody. Welcome back to those who've joined one of our quarterly multi-asset webinars before. And welcome to everyone who's joining for the first time. I hope you're all keeping warm. As you can see, we're in the Cape Town head office at 10X. You can see behind Chris and Anton, it's very gloomy and grey out there. So yeah, we're glad this is a webinar and we're not trying to get people driving around in the bad weather to come and see us. And yeah, for those of you who haven't joined before, Chris and Anton will have a look back at last quarter, see what moved the dial, and then discuss some of the themes, the key themes that we are going to be watching in the quarter ahead. Anton Eser is CIO at 10X, and Chris Eddy runs our multi-asset funds. The presentation will last for around 40 minutes, and then we're going to save 20 minutes at the end for live questions and discussion. So please feel free to use the Q&A tool during the presentation and just pop through any questions that spring to mind, and then we'll have plenty of time to discuss them at the end. So with that, I'm going to hand over to Anton and Chris, and yeah, let's kick off.
Great, thanks, Michelle. Morning, everyone. Great to have you on the line. That should be up there. We should have the presentation up. Michelle, can you see it?
Yes, looks clear on my side. Thank you.
Okay, great, excellent. So as Michelle said, the typical approach we are following is just a little bit of a look back in terms of the performance over the last quarter. And then we, as we did last quarter, just kind of deep dive into three kind of relevant themes, but most importantly, the so what around those themes and what they mean for the portfolios. And then just a final wrap up at the end in terms of how we positioned across our main fund, the Future Fund. So this slide here shows the performance of the relevant asset classes that we invest in across the portfolio. So you can see we've kind of shown it over the 3-month periods of the last quarter, and we've also shown it over the last 12. I think the call out really to make compared to when we did this 3 months ago is for the first time we're seeing SA assets actually looking a bit stronger than global ones, which is the first time really in a long time. So you can see that SA equity and SA property have done relatively well, but also the performance of the currency. We'll talk a little bit about this in the next slide. As you can see, when you look at global cash, for example, over the last 3 months, it's generated negative returns of 2.3, which means most that's coming from the appreciation in the rand over the 3-month period. And actually, we've actually had 12 months now of appreciation in the rand. So that's one factor which is going to be an important discussion point as we kind of look through, particularly the reaction to the election. And then the other one is around the continuing performance in US equities. So you can see that although developed market equity 3 months has been negative, actually US equities definitely year-to-date basis still remain strong. And we'll talk a bit about that as we go through the next few slides. What we've got here is just to kind of provide some context for one of the big themes we're going to talk about today, which is the so what around the coalition government and what that means for our positioning. But just to provide some context here, we've shown the relative performance of kind of relevant asset classes over the last, what's it been? And this is over a month period, so since 5 weeks really since the election. And then we've compared that to when Ramaphosa took leadership of the ANC back at the end of 2017, which is over a 2-month period. This is about a month. Really just to kind of call out a couple of observations. Firstly, you can see that some government bonds, so SA bonds, have done actually really well over that period of time. Not quite as well as we saw post Ramaphosa, but we've generated very good returns in government bonds over that month period with significant drop in yields. And then secondly, I think the other one, which is important, is that although the SA equity market itself has not generated very strong returns, so just under 2%, there's been a very strong rotation in the local market from more locally invested companies like banks and financials. So you can see there 10.4% through in terms of the performance of financials, whereas the kind of the more offshore focused companies have underperformed. So although the overall market's kind of up a bit, it's actually been more a story of rotation within the local market than it has been actually outperformance of the local market. And then finally, you can see there, first glance, the currency hasn't actually done a huge amount over that period, whereas you can see, post from opposer, we had a 15% appreciation in the currency. And I think that's kind of, that there has been, some relative underperformance, but actually it's more in the context of what we've seen in terms of the performance of the dollar, and there has been really more than the performance of the rand. So what we've done here is we've plotted the rand versus the dollar over the last year, and then the dark blue line is just a basket of emerging market currencies. And you can see actually over the period, that kind of 1 month and a bit period, that we've had a pretty big depreciation in EM currencies, an appreciation in dollars, whereas the rand has been relatively flat. So, the currency performance must be seen in the context of the strength in the dollar over that period of time. So I think those are kind of the three observations, which if you just keep in the back of your mind when we start to talk about the implications of the coalition for asset classes in SA and kind of our views on that. Final point to make just before we move on to kind of the forward-looking themes is this real continuation in mega cap tech rally, which we've seen, for a number of years now. But that, as you can see from this chart here, where we compare the US kind of mega cap tech stocks relative to the equally weighted S&P, and that relative performance just really continues to accelerate over the last 3 months. So really a kind of a continuation of that, and that has been, I think, important for our performance over the last few months. So you can see there that we've marginally underperformed the category over that period, and really most of that has come down to the defensiveness that we have in our global equity portfolio, and within that, the kind of defensive position we have around kind of US large cap tech relative to the portfolio, which is not a call on US large cap tech, it's more a call on diversification. So what we're going to do today in terms of covering out these three themes is we are going to spend most of the time going into the SA kind of long-term views, and in particular how we are positioned and what we've been doing. If you remember last quarter, we did talk quite a bit about US equity valuations, in particular long-term concerns we have around US equities. We're not going to cover that again, but what we're going to do is we're going to go into how the fund has been positioned and how we bring more diversification into the portfolio, and what we've been doing in terms of our overall kind of global equity position. So kind of taking that theme to the next level down. And then finally, obviously for all of us on this call, where we are in terms of the US economic cycle, what it means for inflation and what it means for interest rates. We're going to kind of cover that, but most importantly, we're going to take that into what it means for the real return expectation for over the long term for global bonds, and particularly US bonds and index-linked bonds. So those are the three themes. Chris is going to cover the first one, and then I'll cover 2 and 3, and then Chris will wrap up for us. So Chris, over to you.
Thanks, Anton. Yeah, I mean, before we get into the details around the government of national unity and potential growth outlook and what that means for South African assets, I think it's important to take a step back and really zoom out and look at what has been South Africa's biggest challenge over the last 15 years. And ultimately, that's been declining economic growth. You can see here, we've just plotted SA GDP growth. And really, post the GFC, kind of 2008, you can see that trend has been in a downward trajectory. And that's been a meaningful headwind for the South African economy, or more broadly South African assets, because ultimately low economic growth has led to a deteriorating employment picture. It's led to a deteriorating fiscal trajectory from a government finance perspective, and ultimately led to an accumulation of debt on the South African government's balance sheet that really has increased risk premium associated with South Africa. So we've seen significant increase in real rates set against a low economic growth environment, and that has really been a headwind for broader South African assets. I think one of the big challenges and why that Ramaphosa period was quite short-lived, it was a really strong rally in markets for kind of two months when Ramaphosa was elected as president of the ANC, and pretty much petered out on his inauguration as president of the country, because I think the challenges that he faced at that time in terms of the extent of state capture and really kind of the degradation of state institutions were so enormous that even with the right policy, there was a lot of work that was required to turn the ship around. And what's quite interesting, and I think really important for us seeing the election results, is that with Ramaphosa back as head of state and president of South Africa, we see continuation of really a project that he has been the main sponsor of. It's Operation Vulindlela, which has really been centered in the presidency, and it's been run in conjunction with National Treasury. And what it's really focused on is unlocking structural reforms in South Africa. I think for the last 15 years, we've continually heard about the need for structural reforms to be passed. What needs to be done is not new. The issue is actually the implementation around that. And that was really prioritized since about the end of 2020. It was focused on, and this is quite key, it was really focused only on 5 key areas. It was really the network industry, so that's electricity, digital spectrum, water supply, logistics, and the visa regime. And the issue from a government level is that the implementation of policy was not happening in the relevant ministries. It's not saying that the policy, actual economic policy, was wrong. I mean, if you think about it, the unbundling of Eskom was first spoken about in a white paper in 1998. Now that has finally happened. As of the 1st of July this year, we have a separate transmission company. It just talks to the fact that the policy wasn't necessarily wrong, just nothing was happening from an implementation perspective. So the fact that we're going to see another 5 years of Operation Vulindlela is a big tick and a big positive for South African growth. And in light of the Government of National Unity, it's certainly a broadly supported reform that will hopefully unlock growth. This is just a quick update on numerous of the activities that fall under Operation Vulindlela. And I think the key positive to point out here is nearly 50% have been completed with no further work required, and ultimately close to 75% have really been passed through with very little additional work required. So we've got about 25% where there's delay or there are serious challenges. And so what that means is that we are finally starting to see structural reforms coming through, which is a big key to unlocking economic growth in South Africa. I think the first place where we can all feel that has certainly been at Eskom. Chart on the left-hand side just shows you how over the last kind of 3 to 4 months, we've seen that energy availability factor increase materially. You've seen unplanned outages decrease materially, and there has been a tick up in planned outages. So that's maintenance that's happening. And ultimately what that means is we've now seen more than 100 days of no load shedding in South Africa. The Reserve Bank estimated that we lost about 1.8% of GDP growth last year due to load shedding. So if we say under this program, we're now turning Eskom around, we've seen the end of load shedding, and you're not really doing things materially better, you're just doing things a lot less worse, and you potentially have the ability to add another 1.8% of GDP on top of 0.7%, you're already immediately getting above 2%, which is where we need to be sitting to tackle ultimately the debt picture as well as unemployment in South Africa. Now, a couple of cynical comments, I think, leading up into the election around the fact of why load shedding has disappeared is just because we've been burning more diesel. But the chart on the right-hand side really shows on a year-on-year basis across 4 key KPIs, Eskom's improvement has really performed. They've been burning less diesel, there have been lower unplanned outages, much better planned maintenance, and as a result, materially better energy availability factor. So what we are seeing is progress before the new government even comes into existence in South Africa. So we've got a lot of momentum behind us from an economic perspective. 2024 for Transnet will be our big issue to turn around. But again, we are seeing material improvements. Equally, we saw 1.8% of GDP lost to load shedding, 1.4% of GDP last year lost to really logistical constraints. So you can see the big drag on economic growth that we've had. But the charts on the right-hand side, again, show progress in terms of congestion in ports. And the big driving force here is really with Transnet to separate the owner and the operator of the asset. So really by doing that, you can bring in competition from an operator perspective. There's certainly signs around private sector participation. So again, good progress and movement seeing on the logistical side. So set against that, before we even talk about positivity around a government of national unity, the backdrop is significant economic momentum and improvement in economic outlook that has been happening. And because really of the growth challenges, there's really foreigners have had a very negative and rightfully so view on South African assets. So really since about 2016, there's been about 2 trillion rand of South African assets sold by foreigners, about 1 trillion rand in SA equities and another 1 trillion rand in South African bonds. So foreigners have been selling South African assets consistently for the last 7 to 8 years. And equally, from the local perspective, with the changes to Reg 28 and the increase of offshore exposure allowed to pension funds from 30% to 45%, there's been a consistent selling from locals over the last 2 years. And you can see the grey bar is South African pension funds exposure to international assets. So from 2022, that consistently ticked up from 30% to roughly over 40% now. So that move has happened from South African pension funds. So you've had foreigners selling assets, you've had locals selling assets, and that consistent selling has really driven a derating in South African assets. It's really some of those structural selling forces we think have certainly come to an end. And the result of that is that South African assets are at a significant discount in terms of valuations. So here we've pulled out the South African equity market. We're looking at the CAPE ratio. So we spoke about that in our last webinar, the cyclically adjusted PE ratio. It's our favorite measure for equity market valuations. And what you can see compared to a 20-year average, we're currently at about close to a 20% discount. So CAPE ratio is on 13 times. And again, if you kind of contrast that to the non-starter of Ramaphosa, well, expectations were exceptionally high when he came into office in 2018. And you can see that the JSE equity market was sitting on 19 times earnings, actually close to a 20% premium. So there's roughly a 40% discount to that Ramaphosa area. And you kind of put these pictures together. You're saying, okay, we've got some momentum in economic growth in South Africa, which hopefully over the longer term can improve the fiscal trajectory and really drive a lowering in real rates. You've got foreigners who have been selling assets consistently, and you've got a market at a significant discount. So there certainly are really across the board a number of key variables that potentially could support better performance from South African equities at this point. If we look at South African bonds, Anton spoke about the big rally that we've seen in South African government bonds over the last 6 months. Last 6 weeks, really, since the government election. And what you can see here, we've got in lighter blue, that's the South African 10-year real yield, and that's with the axis on the right-hand side. And the darker blue line is the 10-year nominal government bond. So we really haven't seen a move in real yields. They're still quite elevated. above 5% real. And really the rally in bonds has been driven by nominal government bonds. So we've seen a compression in that inflation break-even as the risk ultimately of an EFF and MK coalition has been taken off the table. So ultimately the next move down should be driven by real rates, which potentially will provide the underpin for SA equities to re-rate back to a more fair value, longer-term valuation. Obviously, so through our lens, both SA equities and SA bonds are attractive asset classes to own, both from a valuation perspective as well as with the tail risks that have been priced out of the market. However, in order to own those, if you're sitting at 45% in a Reg 28 retirement fund, you would have to bring assets back to South Africa to own that. And obviously, there's always a question around the currency. So here we've pulled up a chart where we look at the real effective exchange rate of South Africa. And what you can see is that we have had a rally really over the last 12 months in the currency, as Anton mentioned, in terms of the strengthening rand. But where we've got back to is really just sort of an average over the last 10 years, which has been that environment where we've had declining economic growth, significant increase in challenges to the broader South African economy. So you could kind of say fair value to a low growth environment. But as we stretch that period out, you can see that there's still a significant discount to the 30-year real effective exchange rate. So there potentially is room for the currency to strengthen even further from this point on a valuations basis. So really the general outlook for South African assets have materially improved. In terms of what we've been doing in our portfolios around South African equities and South African bonds, here we pulled up two charts from the end of 2022, when obviously we started responding to the changes in Regulation 28. We had a reduction in South African growth assets, so South African equities and property, from about 44% in the portfolio down to really lows of about 33% based on some of the challenges in the high real rate environment. We started in March this year closing that underweight position to South African assets purely based on a valuation basis, and as some of the tail risks around the election outcome have been priced up by markets and haven't actually eventuated, we've actually moved into an overweight position in South African equities. And similarly, on the chart on the right-hand side, you can see in December 2022, we held about 10% in South African bonds. And off the back of increasing yields and more attractive valuations, we continued to add to South African bonds over the period. And we have about 18 to 19% allocated to South African bonds, which we'll cover off later, are set to deliver equity-like returns over the next 5 to 10 years. So really an improved outlook that has been reflected in our portfolio positioning. So really just to summarize what we've covered here and the so what and what the key takeaways are, is that we've seen positive momentum around structural reforms for the first time in South Africa for really in the last 15 years. And we think some of those are underappreciated, but more importantly, it provides positive impetus to broader economic reforms that are set to continue under the government of national unity. And really a growth unlock can drive real rates lower in South Africa, which is ultimately the discount rate and the hurdle to investment. Low real rates hopefully can drive a crowding in of investment and really a re-rating in South African assets. So we've had years of both foreigners and locals selling assets on a structural basis, which have left South African assets cheap and under-owned. So you put all of those together, attractive valuations, potential for better growth unlock, as well as positive momentum around the election outcome, has seen us allocate a higher allocation to South African assets across both fixed income and equities in our portfolio. So yeah, really an improved outlook on South African assets.
Great, Anton. Great. Thanks, Chris. Okay, so just on to the next couple of themes. So the first one, which I mentioned earlier, is just around US markets. I'm sure all of you are following this closely, and for those who kind of were on our last webinar, we talked a lot about the US market in terms of where we are in terms of valuations, and what that means in terms of the long-term return expectations for US equities. We'll cover that at the end, but from our perspective, it's a negative kind of real return expectation by holding US equities over the next 5 to 10 years, and we went through a lot of that in the last webinar. But as with all these things, we have no idea when that's going to change. The timing of these things is very difficult. And it continues really. So these two charts are super interesting. The one on the left-hand side talks about the weight of the top 10 stocks, of which we know most of those stocks are tech companies. So the likes of Nvidia, Microsoft, Apple, etc. The biggest kind of majority of stocks in the top 10. And you can see really that now we are at this point where the top 10 stocks are 37% of the S&P 500. And if we kind of wind that back to what we thought was the recent peak, the end of 2020, it was 32, and back in 2000 in the TMT bubble, it was 28%. So 28 becomes 32, becomes 37. Who knows? It could become 40, could become 45, 50. It's very difficult to know when this kind of concentration in US equities starts to change. I think interesting on the right-hand side actually is, this is just to fix the heading, it's the earnings contribution of those same top 10 stocks in the S&P 500, and you can see that that is actually 27% when you round that. So 27% of S&P 500 earnings are coming from these top 10 companies. So a big number, but relative to the market cap, it's obviously a lot lower than the market cap. So just another kind of set of charts which are super interesting in terms of what is really an incredible disproportionate outperformance of a number of companies relative to the rest of the US equity market, and actually to the rest relative to the rest of global equities. Now that's a multiple type of relative kind of proportion. If you actually look at earnings in the US. So this is the actual reported earnings is the kind of the thicker lines, and then the grey ones are around analyst expectations. So what we've done here is we've kind of drawn a line over the last the last 6 reporting quarters up until the most recent one. And you can see there's been minimal earnings growth. This is across the whole of the S&P and over that period of time. So pretty much flat since the end of Q3 2022. But then when you look at kind of bottom up analyst earnings expectations between really the second quarter up until the same period over the next 18 months or so, 17% is baked into that earnings expectations. So I just want to leave, we've covered this in so much detail, but I think the point to make is that this is as much around multiples being in the top, the top percentile, as it is around the fact that when you apply that multiple, you apply a multiple to the next 12 months earnings, and those earnings expectations you can see are incredibly high. So a lot is baked into optimism and earnings, and a lot is baked into the multiple. So that's kind of just to add a little bit more context to the US market, but I'm sure you all really are very familiar with what's going on there, and keen to get your questions and observations in the Q&A. But most importantly, what we wanted to cover today was just a little bit around what we've been doing in terms of the portfolio over the last 18 months, in terms of how we've been managing what we think is a significant risk to global equities, which is around this US equity valuation issue. So you can see on here we've plotted 2 lines. The light blue one is the S&P 500 CAPE ratio, and the what's happened to that since the end of December 2022, and you can see that's gone from around 26-ish to most recently close to 34. So continuing increase in the Cape. And then the dark blue line, the one above there, actually shows what our global equity exposure is over the last 18 months. So back at the end of 2022, in fact, actually global equities were still pretty expensive relative to historic Cape. I mean, the historic Cape was around 24, 25. So we were most certainly not, from a valuations perspective, believing that there was fantastic long-term real returns. In fact, our kind of global growth benchmark allocation is around 35%. So at 32, you can see that we were kind of expressing a marginal long-term underweight in global equities because that Cape was above historic. But really, over the period of time, you can see that Cape has continued to increase because what we've seen really over a period of time has been less around earnings and more just around a multiple expansion. So the 26, as I mentioned, has become 34. And as you can see, the dark blue line there, you can see has been a continuing kind of decline in our exposure as the markets got more and more expensive. So you can see our exposure has gone from 32% marginal underweight to 27%, which is a pretty big, pretty significant underweight. And all of that is really expressed through US equities. So I think what we're trying to describe, and it's similar to one that Chris set out, the previous one, is just how the valuations approach impacts the way that we effectively are managing the total exposure to equities. And then within that, once we've made the allocation to global equities, we then are also trying to ensure that we have as much diversification within the portfolio as possible. So there's a lot of things on this chart. I want to pull out three. So firstly is on the geographic exposure. And remember, we're not stock pickers, we're not sector allocators here at 10X. We ultimately use diversified baskets and indices to gain exposure, and we ultimately are trying to ensure that the end portfolio positioning is diversified and not concentrated. So you can see here within here our geographic exposure by virtue of the combination of building blocks and indices we use has an underweight to the US. We're making absolutely no call on whether the US is going to outperform or underperform over the next 6 to 12 months. But we are saying over the next 5 to 10 years, US equities are the most expensive asset class in global equities. So, hence our kind of underweight there. The second one is the bottom right one, which is this pointer on the top 10. So through the way we construct the portfolio, 11% of our global equity exposure is invested in the top 10 companies, whereas an ACWI type of global equity is over 20%. So 22%, incredible to think 10 companies represent nearly a quarter of the total global equity universe. And then the third observation is by virtue of the way that we've constructed this, our Cape ratio is significantly lower than the global equity market exposure. So I think I just want to leave this section with those 2 points, is that, as valuations got more expensive, so our exposure has decreased. And then secondly, within the global equity exposure, we have a defensive portfolio across our global equity funds. So it's not just a question of total exposure, it's also a question of how the underlying portfolio is constructed to ensure that it's actually defensive, and we, as far as possible, are reducing the risk to this kind of concentration risk in the US equity market. So that's that point. The second point I was going to cover, which is a long discussion, which I'm going to make super quick because I'm just kind of conscious of time, which is a debate we have a lot around the desk, and I'm sure you all do as well. Is where are we in the US economic cycle? Although China's important, although Europe's important, really it's all around what the Federal Reserve does and what happens in the US, which ultimately is the crucial market for us to gain an understanding. And we all know where we are in terms of rates are still relatively high in the US, so we haven't had a rate cut. Inflation, obviously, after peaking, back in 2023, is kind of now around just over 3%. So a lot of that is being driven by inflation, and inflation has come down significantly, as we all know. So in terms of the what that means for where we are in the cycle, I think there's a couple of charts which you wanted to call out. So firstly is this is the chart which basically sets out, since the last rate hike, how many months does it take between when we have the last rate hike and a recession. And notable that you can see that those months are a lot longer since Greenspan took over the Fed. So you can see, 1990 took 17 months from the last rate hike. In 2001 it was 10. 2008 it was 18 months. So we had the recession in 2008, which was 18 months since the last hike. So we're 12 months into this cycle since we've had the last hike. So we're kind of average. It has been a cycle which has been definitely extended by virtue of what's happened in fiscal, which we'll talk a lot about in the next slide. But the interesting observation here in terms of where we are is that we are most certainly starting to see defaults pick up in the US. So I can mention the 2001 cycle you can see there in the chart, and then 2008. So, as interest rates, as you would expect, as interest rates go up, so companies have to refinance, and the more marginal ones, it impacts the kind of their coverage ratios, and you start to see defaults. We're seeing a lot more in the loan market in the US because the loan market is a floating rate market, whereas the bond market is a fixed rate market. So you're starting to see a lot of companies having to refinance at a much higher rate, and so defaults are picking up. So we definitely are late cycle in terms of where we are. Is it another 6 months, 12 months? Obviously we're not here to forecast the economic cycle, but more make the observation about where we are and what's happened historically, and that we are starting to see the economy come under pressure in terms of defaults. Fiscal spending has been a huge support. We've covered this in a lot of previous presentations. And really, the overriding point I want to make in the next couple of slides is that ultimately, if you kind of look at previous cycles, you would look at where we are right now, and you would say, right, at some point in the next 12 to 18 months, we're going to have a recession. So that means we should expect interest rates to be cut, pretty significantly, from well over 5% to something closer to 2.5% over the next 18 months if we go into a recession. It's a pretty high probability scenario, and then hence one should own duration. So in all previous cycles, with Treasury bonds, US Treasury bonds close to 4.5%, you should hold US Treasury bonds, and you should be long duration going into that cycle. And it's most certainly kind of a view which we understand, and the real return expectations in that market are pretty good. There are two observations that we want to make here, which is something which impacts the way we position the portfolio. Is firstly, based on the significant amount of fiscal spending we've seen post-COVID, and actually the debt that was built up beforehand, there is a huge amount of government debt that needs to be rolled over in the US and other developed markets, and actually emerging markets, over the next 12 to 24 months. There's something like $9 trillion really in the next 18 months in the US that needs to be funded. So, and we have the issue of potentially Trump getting into the White House, and obviously the whole issue around fiscal spending there. So there is a meaningful risk, and we've covered this in a lot of detail, around a government bond type of funding crisis. So obviously, if we have that, that's not particularly good for yields. And then the second one, which is, there's a lot of different views around this as to really what happens to inflation, putting aside that point that made around kind of fiscal funding. But this is this whole issue around protectionist policies, around a large elements of kind of deglobalization being behind us, and rather than being deflationary, becoming inflationary. It's a separate, long, deep dive webinar in itself. But there is this possibility that we are no longer in a disinflationary environment. And this chart's pretty interesting, and it plots the CPI in the previous time we had inflation. And you can see we had that spike originally, and then we had a kind of second spike after that. So, there is most certainly a lot of good reasons why we may be actually set for another inflationary environment. Once again, we are not forecasting, a recession. We're not forecasting inflation. We're making observations here around previous cycles and around what the probabilities are. But the reality is that if you look at the bond market and the inflation market, there is very, very high conviction that inflation will normalize, and that 2% is something which ultimately the central banks will be able to achieve. And you can see this in what's called the break-even curve. So this is the assumed inflation through the linker versus nominal curve in the US. And you can see that 3-year break-even at 2.2% is giving you absolutely no inflation optionality in the way we think about it. And that is saying that really we will return back to 2% or thereabouts over the next 3 years. And from our perspective, that means there's no premium that you kind of have there, and it's a great way for us to at least bring in a second element of this. And this is kind of just to wrap this topic up. Is I'll say the concluding points is that we're late stages in the cycle. However, and that implies a recession, and therefore interest rates will go down, and you should own duration. However, there is a real issue around inflation, which really is an important factor. We could actually see another spike higher inflation. We could actually see a bond market issue as well. Although that's not our base case, the reality is we have a fantastic opportunity to hedge that view and through break-evens being really low. And therefore, what we own within the portfolio, both globally and actually in the local market as well, as Chris mentioned, is we have a pretty decent allocation to TIPS in the US and index-linked bonds here as locally, which provide us that hedge against higher inflation, just given how attractive real yields are. So that's the kind of key takeaway in terms of where we think we are in terms of the interest rate and inflation cycle in the US.
Yeah, and so what we've just brought up here is kind of a standard chart that we generate on a monthly basis. You'll find it in our Global Connect that we send around to clients as well, where we generate capital market assumptions looking out over the next 5 to 10 years, underpinned by current valuations. And I think there really and the picture hasn't changed materially from last quarter either, but really the two key standouts, and we've circled that with those blue boxes, are really the attractive equity-like returns that South African bonds, both across linkers and nominal bonds, are set to deliver between 5 and 6%, which is kind of roughly in line with just below South African equities at about 7% real. And then on the really expensive side of the spectrum, you've got US equities that on a valuations basis are set to deliver about negative 2% real. So that's 2% below inflation over the next 5 to 10 years. So as you kind of just take a step back and you generally look at the defensive asset classes, you'll find that most of the defensive asset classes, both locally and globally, are kind of fair value to attractive, whereas South African equities are really the only asset class which is really set to deliver returns in line with its long-term returns, and that's assuming that there's no change in real rates in South Africa. If there's a decrease in real rates in South Africa for the reasons we've spoken about, that could see a meaningfully higher re-rating in South African equities as well. So what does that mean from a portfolio composition perspective? As we've articulated, certainly big changes since the last quarter. There's been a move out of a large allocation to global cash. We still have about 4%, and allocating that into US TIPS, as Anton articulated, in terms of the optionality both for a recessionary environment and the inflation protection that presents. But ultimately, because defensive assets are more attractively valued compared to growth assets as a whole, our portfolio is still relatively defensively positioned, where we've got about a 67% allocation to growth assets, and most of that is really coming through our expression of an overweight to South African equities. So where we're sitting in terms of an onshore-offshore split, we've got about 37% allocated to offshore assets, so that's reduced from about 42% at the last quarter, and that'll give you a high-level overview of the changes in the current positioning. So still generally defensively positioned, but expressing that overweight to South African equities for the reasons we've covered. And certainly it's great to have some positive news and a slightly more positive outlook around South Africa after multiple years of what has been a declining outlook and environment. So good to end off on some positive news there as well. So thanks very much. That is really everything we wanted to cover today. We hope you found it useful. And Michelle, I'm not sure if there are any questions, we'd certainly love to engage on what we've chatted about today.
Thanks, Chris. Thanks, Anton. And thanks to everyone who's joined us. Please feel free to pop your questions into the Q&A tool, and we've got some time now to chat about them. Yeah, I think it's with all the narrative that's been going around this year, and upcoming elections in the US, and the elections that have been happening in Europe and in South Africa in particular, it's really helpful to focus on the numbers. I think my takeaway from today is certainly that 2 trillion rand staggering stat about the foreign selling of SA equities and how under-owned they are. So yes, I'm sure everyone's going to have some useful takeaways from today. The US default rates as well. It was quite a staggering stat. The first question that we've had coming through, I mean, you have spoken extensively about the threat of recession in the US and about how defensively we have positioned our portfolios, especially through the asset allocation, and the use of diversification around looking at that sort of concentration rate risk in the US and some of the sectors there. But there's a specific question here coming from David. Thank you for your question, about how we control for volatility in our funds, specifically funds that might be used inside a living annuity, and where obviously for people that are drawing income are kind of more sensitive to volatility. Perhaps you could talk a little bit more to that. Maybe we should reference the 10x Income Fund more than the 10x Your Future Fund, and what our risk control is there and how we look at volatility.
Yeah, so I mean, we run a range of multi-asset portfolios which are really outcome focused, and we express those outcomes in terms of inflation plus and the relevant time horizons. Today we've covered the 10x Your Future Fund, which is our high equity equivalent, so target CPI plus 5.5 of a rolling 5-year basis, and it's really the expression of our best investment view for long-term investors wanting to accumulate wealth over the longer term. So we, alongside the 10x Your Future Fund, we also run, expressing exactly the same views, just dialing down the risk level. We run moderate and defensive portfolios, but more appropriate for living annuity investors. We also run the 10x Income Fund, which purely owns fixed and floating rate investments, so there's no growth assets. It targets inflation plus 2.5 of a rolling 3-year basis. And given the really high levels of real rates that we've spoken about today on offer in South Africa, you're actually able to generate, and looking where break-even assumptions are, you're kind of locking in a real yield in the income fund of about inflation plus 5 to 6 currently, which is exceptionally high, and it is a great place to invest, certainly for investors who are more concerned around short-term volatility because the fund does not have any growth assets in it. So it gives you a bit of an overview of the different tools available to investors that they can use to match against the goals that they're looking to achieve.
I want to just add a couple of points there. I mean, firstly is around exactly that, is that the ability to actually hit very good CPI plus returns through defensive assets is a very important part of the way we think about the portfolio. But then also secondly, this whole thing around kind of global equities at the moment is I think a really great way to answer the question that David's answered, is that that investing in a way whereby as markets get significantly more and more expensive, and you effectively de-risk the portfolio as markets get more and more expensive, is in a sense a way of also ensuring that you bring more and more less volatility and more diversification into a portfolio. It's almost an investment style which kind of is aimed towards volatility reduction in terms of hitting that outcome.
Yeah, and I mean the way that we kind of do that and what we run internally is that we stress test these portfolios. So we use a valuations-based approach to construct the portfolios Anton's spoken about, but then we'll stress test the portfolios and run them through different scenarios, market sell-offs, kind of like a 2008 financial crash, to understand if we're introducing too much volatility or there's too much of a risk of drawdown that's not acceptable. And we really use that as a risk control to help moderate that valuations-based approach as well.
Thank you. I think maybe it's also worth touching on how we hedge the currency as a separate lever. So I think for a lot of portfolios, having any offshore exposure introduces, of course, volatility, because the rand is quite a volatile asset class. But I don't know if you want to maybe talk about your process just for a minute. I know we've spoken on webinars before, but we haven't touched on today's session about how
it depends on the portfolio, because the rand can also be a great diversifying asset class as well, where you're holding a large allocation to growth assets, because it's really in a risk-off environment, typically globally risk-off, you typically see the rand depreciate. So for us, it's really based on how much, what the allocation to growth assets are in the portfolio that would kind of drive that, the allocation to the currency really is that risk diversification lever and tool that we can use. So currently, as we've have a lower allocation to growth assets and a lower allocation to growth assets globally, we actually have slightly reduced allocation to hard currency as well.
Okay, great. Okay, a few other questions coming through. Do we have a view on global property? Can you talk about that, please?
It's a favorite one. I mean, I think we don't have a view on global property. We kind of see it very much as being part of the global equity universe. It's a subsector within global equity, and so it's strange to kind of like carve it out and have it as a separate asset class. So we kind of see it very much as part of the global equity asset class.
Okay, thank you. What in our low equity fund, which is the 10x defensive fund, what is our global exposure? And perhaps you could also talk to what's hedged and what's unhedged there as well.
Yeah, sure. So we have about it's about sort of 25 to 26% invested offshore. The hard currency exposure there is sitting down at closer to 18%. And the reason for that is because we have a much higher allocation to defensive assets. So there is less of a need to hold diversifying hard currency exposure. And because the time horizon of the fund is also shorter at 3 years, one needs to be cognizant of the amount of volatility that hard currency introduces into the portfolio. But kind of the hedged out currency exposure is really kind of that allocation to the US TIPS market, which provides, again, kind of a hedge against a global recession, as well as sort of embedded protection to another uptick in global inflation.
Okay, thank you. A question here from Andre: 10x your future versus 10x total world with regard to CPI plus 5. So I think maybe it's worth just distinguishing within our product range. We've got a range of building blocks, i.e. 10x total world is a building block allocation to global equities. So it doesn't have a CPI plus target. So all it seeks to do is track a market cap weighted very broad index, which is called the FTSE Global All Cap Index, versus 10x Your Future, which is a solution with targeting CPI plus 5.5%. Yeah, I don't know if there's anything to add to that.
I think I would just add one point, Michelle, is if you look at this chart here, and you look at the combination of DM equity and EM equity. So just you look at the kind of the real return expectations based on our capital market assumptions are clearly very, very low, whereas the real return expectations from the future fund is significantly kind of close to 5.5–6%. That's just our framework. It's not a prediction. It's just saying that actually global equities based on our framework will underperform future fund over the next 5 to 10 years just goes based on our kind of capital market assumptions and the point that we make around defensive assets and local assets actually being fairly price relative or attractively price relative to global equities.
Thank you. So in rand terms for locals.
Correct.
Yeah, that's interesting. Thank you. A short question here. What is US TIPS on the last slide? So that's obviously inflation-linked US bonds, so the equivalent of South African inflation-linked bonds. Yeah, we call them ILBs.
Great. Yep.
Okay, so question from Nicholas. Would it make sense to gain US equity exposure through an equal weighted ETF versus a market cap weighted ETF if there is an expectation of rotating out of the mega cap tech stocks?
Yes, is the short answer. The timing of that is obviously very difficult. But when we look at the way we've constructed the exposure that I talked about a little bit earlier on, where I talked about the US exposure, etc. Actually, what we do is, because we're not picking stocks, we're not picking sectors, is the allocation that we have is a combination of market cap, equally weighted S&P 500, and then we have a kind of a dividend global divvy strategy as well in the portfolio, which is accessed by the portfolio. It's actually that equal weighted S&P 500 we've held for about 9 months now, right? So 9 months. Once again, it's underperformed. We don't have a view on whether it will outperform in the next 6 to 12 months. But yes, most certainly the way to capture that is through an equally weighted basket, and we hold that in the fund.
It brings in a lot more diversification.
Yeah.
But to that point, there has been a bit of pain recently, but you can see. So this is effectively the relative chart comparing the market cap versus equal weight, and you can see there's been significant outperformance of the market cap, but over time that typically does revert as well.
And for those of you who are familiar with our product range, we don't have an equal weighted global ETF within our range, but we do have the 10x Global Dividend Aristocrats ETF, which is a very different sector and global weighting to market cap. So that if you're looking to diversify away from that tech heavy, US heavy sort of market cap weighted benchmark, you could have a look at that one and ask us for a bit more information. Another question here about list access and the 10x Total World Fund. So 10x Total World strategy is available as a unit trust via lists and as an ETF, obviously for access via share trading accounts. And those are the kind of 2 ways to access that strategy. So it is not only available via a list, you can also access the ETF. Hopefully that answered the question. And then I think we've got time for one last question here before we close. Surely declining US interest rates will further fuel US equity valuations?
Yes, that's absolutely a possibility. And it's definitely something we're conscious of. But the reality is that a decline in interest rates, a significant decline in interest rates, will be on the back of a significant recession and a big dent in terms of the earnings expectations that you see, which is that chart that I talked about a little bit early on, where we have a pretty big expectation around earnings going up. So I think, in a sense, that would potentially be the steps on this are very difficult, and we're not forecasting the steps. But the reality is that it would be, given how elevated the earnings expectations is and how elevated the multiple is, that and a interest rate reduction would be on the back of a recession that would have a more dominant impact on US equities. But once again, we're not calling any short-term view as to what happens to US equities. What we're saying is that over the next 5 to 10 years, given how high the multiple is for US equities and given how high the earnings expectations that are baked into that multiple are, is that your long-term real return expectations in US equities is poor. But it's not a kind of call around a recession and what happens to US equities or interest rates over the short term. So I just want to kind of call that out very specifically. We have a view, we have thoughts, we talk about a lot. It definitely impacts the way we think about risk. But in terms of our capital market assumptions, it's a long-term capital market assumption around US equities, not a short-term.
And the time horizon that we're managing the fund over in terms of the
Correct.
outcome that we're looking to deliver, which is that longer-term 5-year horizon.
Yeah, but it's a great question, fantastic question. So nice one to finish shortly.
It's the $1 million, $1 trillion question, really. Thank you, Chris. Thank you, Anton. I think we're going to wrap up there. If you guys wouldn't mind putting my final sales slide up for us to close. I'm allowed to put one sales slide into Chris and Anton's deck. So for those of you that enjoy listening to their views, make sure you sign up to our 10X Global Connect. It's a monthly chart book that we put out at the end of every month. Very similar to kind of the topics we're discussing in these forums, but a much shorter, just a 2-pager, sort of on a monthly basis. And we will continue to do these webinars, these quarterly webinars, quarterly. So I hope you'll join us in future. And thank you again for your time today.
Michelle, can I just say one last thing? Sorry, before everyone jumps off, is if we could just have any feedback, in the end, we're trying to make this as relevant for you all as possible. So, and we got great feedback at the last webinar. So if there are any comments, please, feel free to insult Chris, not me, but please get your comments back to us. If you've got any ideas, any information that you would need at these webinars, it would be super useful for us. So, but thank you.
And if you think they should wear a tie, let us know as well, because I've been rallying for that.
No, that's the only one. That's false.
Thanks so much, everyone. Thanks, guys.
Thanks a lot. Cheers.
Thank you, everyone. Bye.